everybody, and welcome into Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day, and on this episode, I'm very excited to welcome Vince Lanci to the program. A professional derivatives trader in the commodities space for over 25 years, an adjunct professor at the University of Connecticut, and the publisher of the Gold Fix newsletter on Substack. We're going to dive into the Genius Act. Is this a legitimate policy that could inject much-needed liquidity into the U.S. Treasury market, or a nefarious plot to force financial surveillance on the population without issuing an official central bank digital currency? We're going to walk through Vince's thesis on gold revaluation and why he believes it's far from a gold bug fantasy. It's a reality staring us in the face right now, and it's going to happen. How will governments implement it, and what could the implications be for the gold price? We're also going to dive into silver and why Vince is calling for a triple-digit silver price. Far from hyperbole, he breaks it down step by step in one of the most epic explanations of the silver market I've heard on this show to date. All of this and so much more ahead in my conversation with Vince Lanci. Vince Lanci, great to have you on Commodity Culture. I want to kick things off with discussing the Genius Act, because some are calling this a fantastic move that will ignite the lagging U.S. Treasury market. Of course, the Genius Act involves stable coins, which are backed by short-term U.S. Treasuries, but others are saying this is a way of ushering in financial surveillance without officially issuing a central bank digital currency. I'm wondering what your thoughts are. First of all, break it down for us from your perspective. What is the Genius Act, and what are its potential implications for the US dollar, the stablecoin space, precious metals, and financial privacy in the United States?
First of all, thank you for having me on. The Genius Act is a regulatory piece of legislation that's going to allow and encourage the U.S. to develop stablecoins at FDIC banks and other firms that are probably going to be given permission. The purpose of it is, is it good or is it financial surveillance? I think that's what you alluded to, right? It's both. It's both. Not to be cheeky about it, but what the Genius Act will do is it allows banks and whoever else is permitted to create product, and that product is a stable coin, and that stable coin will allow people to, using it as almost like a cash surrogate, allow them to invest in other assets with it. And so because of the nature of this, what it does is it allows cash-like instruments to be used as cash collateral without having to sell them. So if you and I have a money market, for years I didn't understand that a money market was literally a fund, but you have to liquidate it. And in liquidating it, you can buy something else. So the stable coin doesn't have to be liquidated. The collateral is fungible as it is. You don't have to sell it. And that's very important at the financial speed level. It's also very important for making sure no one's double counting money, or it cuts down on problems. It secures, here's the most important thing. Here's the thing that tipped it. It secures a new buyer, in quotes, a new nation of buyer of treasuries, and in a small way replaces the need to own treasuries to buy oil. Think of it as a money market alternative. Should I get into like how it's going to be used?
Absolutely.
Okay. It will be used. It's already being used by foreign nations who are enticed to invest in the U.S. via FDI. FDI means foreign direct investment, in case people aren't familiar with that. There's an Abu Dhabi-based firm. I'm going to give you a real example of it happening right now. Whether you're pro or con, it doesn't matter. It's happening. There's an Abu Dhabi-based firm, MGX, I think is their name. I don't know what the letters stand for. They are using a Trump-affiliated stablecoin, USD1, to make a $2 billion investment in the cryptocurrency exchange Binance. So what that is one of the things that we need as a nation to do is have someone else buy our debt. Now, either it's going to be someone else or it's going to be us or we're going to go bankrupt. I'm not trying to sound an alarm, but you have to tighten your belt, right? No one will lend you money. We're going to get everyone to buy one way or another, but focusing on an overseas country. An overseas country is reticent to buy the US dollar, US treasuries, because of the Russian confiscation. And that's material. It's a material risk for them. So what we're doing is we're going to say to them, you can hold treasuries and you can buy equities with it. Foreign direct investment. So basically, you don't have to sell your treasuries. We found something else for you to do with them. And it becomes a stability mechanism. Now, this is literally what happened with the Abu Dhabi firm. They put $2 billion into a stable coin, and they purchased a piece of Binance with it in the US. Now, this brings up all kinds of interesting dilemmas and problems. We're not even getting into the spying on you aspect of it, because that's also very real. I mean, there's a lot of problems with them, but they're going to be necessary. They are the new country that will buy treasuries, whether it be you or me or another nation. And so I'm giving you the pros. There's cons as well. So where should I go with this next?
Yeah, let me know about the cons that you see, particularly the privacy issue and how that could negatively impact the picture of financial privacy in the U.S.
The privacy issue is the most important issue. But before I get to that, give you an idea of what these things are. They will be a laundromat for global players with otherwise sanctioned or illegal money who wish to bring it here. So if you're in a country that has human rights violations and you have money that we can't accept, well, we can accept the stablecoin. So these are workarounds to bring money out of hiding. And I say that, because people will think that the stablecoin is going to allow to give them access. Yeah, the only reason they're giving us access is because they have other people with bigger money. They want to have access. Who knows where that Abu Dhabi money came from? Now they will also spur a bubble, right? But that's going to be down the road. That could take years to pop, but a bubble will form, perhaps in U.S. Treasuries and in the assets that you can buy with them. You and I, we put money into a stable coin and we buy a blockchain gold product, So whatever is the most popular product will benefit the most. But the privacy thing is, well, look, central bank digital currency is a license for the government to directly spy on you. Now, even if I didn't mind them spying on me, even if I wasn't libertarian in my mindset, even if I didn't mind that, I wouldn't trust them to do it the right way. Like I wouldn't trust them to use it properly, and that leads to some serious things. You can redirect the economy in real time. So, for example, it starts with, well, we have a problem in this industry. Let's CBDC. I'm referring to CBDC can be restricted. You can't buy beer with it, but you can buy Hostess cupcakes. Like, who do we want to prefer? And it becomes like a version, a more nefarious version of EBT cards or food stamps, and it's very abusive. It lends itself to abuse, and it's just not culturally going to happen here. And so stable coins, they potentially do the same thing, but you actually are, it's kind of like the tech companies during COVID, right? The tech companies were spying on us for the government, were censoring us. Well, now they can do the same thing through the banks with stable coins. The question is, will they? And the answer is there's always going to be a risk of that. But if you believe that we're a nation of laws, for the most part, and you believe that at least a couple of these banks will think on their own if there's a problem, because they want to protect their own franchise, I think the risk of that, at least for the first 5 or 10 years, is minimal. But down the road, oh yeah, it's definitely it's a centralization tool. They're taking crypto technology and they're centralizing power with it. So it's definitely a nightmare for privacy. I'm worried about the regulations that the banks will be held to govern the stable coins or whatever it is. Banks, commercial bank digital currency is really what it is. But that's it. That's it. I think it's a problem that will be ignored and will become a bigger problem a generation from now. Hopefully not before a generation from now, but it'll be a problem. And I say this as a person who does not vote for the worst candidate. I'd rather have that than CBDCs, and we do have to do it. And I'm speaking as a patriot. We do have to do it to get people to buy our debt. And that's it. At least we're going to regulate it and we'll probably dominate the world in it. There's one other question you asked about the dollar, right?
Yeah.
Yeah, that's a good question. I'm really struggling with that. I'm not sure if it'll be a pronounced effect on the U.S. dollar, but you'd think it would be supportive. I mean, the key is U.S. Treasuries. But I mean, that's it. That's where I stand on this.
And now a quick break to hear from our sponsor, ARK Silver Gold. Osmium owner Ian Everard is considered one of the most honest and level-headed gold and silver dealers in the United States, praised even by his competitors. So give him a call today to take advantage of the specials right now. Silver Kangaroos 2023 1-ounce coins, mint fresh, only $2.47 over spot. Mint fresh silver maple leafs 2025 coins, 1 ounce, $2.87 over spot. While supplies last. Reach out today at 307-264-9441 or by email at ian@arksgo.com, and make sure to tell him that Commodity Culture sent you. And now, back to the interview. Great breakdown. I want to talk about geopolitical instability for a moment, because I've heard you mention that it is one of the main drivers for the gold price. And as we sit here today, there's obviously a lot going on in that regard. So what geopolitical catalysts are you paying attention to the most? And, seeing that geopolitical tension is a main driver for the price of gold. If we saw a resolution to the Russia-Ukraine conflict, everything's good again. In a fantasy land, let's say, Russia and the EU start trading again. We see the wars in the Middle East settle down and everything become peaceful. Again, I think we're in a fantasy world here, at least in the short term. But let's say all of this occurs. Would that be negative for the gold price as well?
It absolutely would. And, when you start with the worst case scenario for gold, in this case, the best case scenario for the world, I agree with that approach, because you have to look at the worst case scenarios and figure out what could happen if it was bad enough, and then work your way into what's most likely to happen. So your description of a kumbaya situation where the world is at peace again, yeah, that would be devastating for the price of gold, and it would be great for humanity. If the Ukraine war ended, bearish for gold. If the Middle East ended, bearish for gold. But I think so. Those are, I call those items. Those are symptoms of the problem. The work that I've been doing in geopolitics for the last 4 years has been looking at secular changes. So the geopolitical issue that runs through everything for all these things that we're looking at and will not go away is a mistrust of anyone holding their assets in custody. So specifically, I'm referring to the dollar, U.S. dollar at the forefront when they confiscated the Russian money. Whether we should have or not, it happened. And so they feel threatened. That served to raise the floor of gold as nations sought to de-dollarize somewhat, to the extent, well, I did it to them, could they do it to me? So let's sell some treasuries, let's buy some gold. Let's sell some treasuries, let's buy some of our own currency, and what have you. And to varying degrees, that happened. And that was happening since 2009, by the way. Since the great financial crisis, you could see the China started to de-dollarize. Now, it wasn't obvious, but they de-dollarized somewhat. And then I think 2016 or 2012 they bought even more gold because they wanted to be a part of the WTO. But that's another rabbit hole. But the Russian Ukraine war served to uh, instigate that. So that floor, that big picture mistrust that is now out there, becomes a reality. You can't miss it anymore. So war in the EU, war in the Middle East, or anywhere else only accelerates, forces the hand of those who have already made up their mind to do this. We're going to buy more gold. We're going to sell treasuries. Well, I don't want to sell the treasuries. We'll let them expire. Right when they come due, we'll take the money and we'll buy something with it. Well, now they're saying I don't want to wait anymore. I want to sell it, and so they're getting out right away. Peace is definitely, but circling back to the gold price in the immediate aftermath, peace would definitely hit gold hard. How hard, I don't know. But the key driver to all this is trust, which brings us to your extreme example, in a kumbaya world. What will it take to make the rest of the world trust us again completely with their money? And you can't put that genie back in the bottle. I mean, we can slow its escape from the bottle. We can get it somewhat in the bottle, but we can't keep it all in the bottle. While that concern could lessen, let's use Russia as an example. That's a good example. Let's pretend that the Putin-Trump summit or whatever they're having goes great. And by great, I mean Russia pulls out of Ukraine and we release their money simultaneously. That's possible, but that's a home run, right? Right. So Russia gives all their land. I mean, we know it's not going to happen, right? Russia gives back all their land, and we give them back all their money. Are they going to trust us? No, because we have a new president every 4 years. Number one. Number two, well, maybe the urgency to buy gold will decrease. Instead of buying at 3,400, I'll buy it at 2,400. But the impetus, that we're in a Cold War now, Cold War 2.0, and I think the Iron Curtain is financial this time, and it's going up between somewhere right down the middle of Eastern Europe, coming to the West. So the genie's not getting back in the bottle. We're in a Cold War mindset, and it's here to stay a while. So I don't think anyone, and we're going to get into the specifics of that, I think, because I think you want to talk about revaluation at some point. And we'll get into the specifics of that as it pertains to why gold's not structurally going to be sold ever again, over the next 10 years. So.
Well, let's jump into the revaluation question because we've seen a lot of talk about it. And obviously, at the moment, gold valued at $42.22 at the Fed's balance sheet. And what has been kicking off kind of another conversation now has been the Fed recently releasing a note called Official Reserve Revaluations. The international experience, which described how 5 different nations used gains in their gold reserves to raise funds. Do you think this is a prelude to the U.S. potentially revaluing its gold reserves? Is that even a realistic proposition to begin with? And what would the potential implications be of either, there's a few scenarios here. People talk about marking to market. Some people say, well, they could revalue it at 10,000, 20,000, and then they would have a whole bunch of extra liquidity on the balance sheet. What are your thoughts on the gold revaluation question?
I have strong opinions on it, and before giving an opinion, I think it would be helpful to set everyone right on this, at least from my point of view. Revaluing gold is very realistic. If things do not turn around soon for the debt situation, it might become a necessity. Now, I want to spend time on that, but I want to address the things that you said first. First of all, will we revalue it to $10,000? No, that's idiotic. We wouldn't do that, right? Number one, just to go down the list, right? Will we revalue it to its current price? Possible. I don't think likely. Will we revalue it significantly higher? I think so. I don't know how much higher, but I think higher. Look, historically, and we did it in 71 and 73, Gold being revalued is a one-off, right? I mean, they raised the price, just the mechanics of it. They raise the price on the books that we carry it, and then the government borrows that much less, or they spend that much more. Essentially, you're tapping a piggy bank. It does not serve us well on its own. It's like, giving an irresponsible child more money without telling them to stop spending money on video games or something like that. So, so as a one-off, it's irresponsible. We irresponsibly did it before. When we took it from like 35 to 42.20, we spent the money, and it happened right before the oil embargo. So it just was a disaster, and it was used irresponsibly. Now, there's some important details of this, and there's some important other things floating around that hopefully I'll be able to tie together. But I want to start by looking at the debt situation with regards directly to gold. All right, the way it could materially help the U.S. Now, I'm echoing something that's already out there, the Mar-a-Lago Accord, whatever. Stephen Moran talked about it, but I want to try and set it straight for people. The way it can materially help us, and do so without being irresponsible, would be to revalue it and, pursuant to the Constitution, use the proceeds to literally retire the debt. Now, I'm not the first person to say this. Grant's Interest Rate Observer had a nice article on it. A couple other professors talked about it. The Constitution has an amendment, and the amendment is that you can't sell gold. Our gold cannot be sold unless it's directly used to retire the debt. So it's a way to tie it to the deficit, and it's actually pretty wise. But there are several ways to do what I just described, but what I described is to retire the debt or to lessen our debt, to use the price of gold to lessen our debt. So the first one would be, we raise the price of gold. Let's just say we raise it to 3,300. Right? I don't think we will, but let's say we do 3,300. And then we can just basically change the accounting ledger to have more money and take that money and do what with it? Well, if you were to go out and buy the debt tomorrow, bonds would explode and we'd be paying a high price for them. It would be bad. You can take that. So that would be stupid tactically, right? But it would be the right idea, right? A smarter idea would be, and other people have talked about this, would be setting up, was it Andrew Jackson, a postal fund, or was it Hamilton? I forget who it was. Set up a postal fund, the guy with the tall hair. And that postal fund would be, you put the money in the fund, and then you trickle it out buying treasuries from time to time. So those two examples, the aggressive one and the patient one, those amount to a QE. It's a gold quantitative easing. You're going to put money into the market by retiring our debt. It's fabulous. Now, it's not easy to do, and here's why. It's not popular, okay? And in order to spend the money on a full revaluation, assuming that we had a full revaluation, you would need to sell or hedge the gold. Now, I'm echoing what Stephen Moran said and a little bit of a loophole that he's working with here. So here we go. Here's what I would prefer, which I think is actually doable. We revalue the gold, 3,300. We take the proceeds with or without selling the gold. It's political suicide to sell the gold. However, we can do other things like hedge it, like lock in price without selling it. Now, this is going to get a little bit wonky, but this is one of the things they can do. All right. We literally buy bonds of other countries whose currencies we wish to strengthen versus the US dollar. Now, you're going to have to just assume that you're going to have to take this as an assumption that's true. If you take dollars and you buy other currencies or other countries' bonds, you are retiring US debt. Of course, you're buying someone else's debt, but you're retiring US debt. Okay. So that is a way to not necessarily honor the letter of the law, meaning we have to retire debt with it, but honor the spirit of the law, because it's just a fact. If you take U.S. dollars and you buy someone else's bonds with it, you're retiring U.S. debt. Yes, you're swapping U.S. debt for some other country's debt, but you're doing it with a trade partner who is going to be buying your stuff. So there's a loop. You're creating a loop there, and that's my, in my naive way, that's my preferred way of doing it. Now, there's precedent for this. We have something in the United States called the Exchange Stabilization Fund, affectionately known as the Plunge Protection Team. Now, what the Plunge Protection Team does is, using various financial means, they will stabilize markets when they need to. And one of the ways you can stabilize a market is, the gold price is too high, then we're going to sell it, or we're going to hedge it, and we're going to take the dollars. It basically comes down to the dollar. If the dollar is too strong, we get dollars and we buy someone else's currency. Kind of like when there's a crisis in Europe and they need dollars, we will swap dollars for their currency. Where do you get the dollars? Well, you get the dollars in the Exchange Stabilization Fund from their fund. And it's not a lot. It's only tactical, and it can only be done for short periods of time to avert a crisis. This, what I just suggested, which is a variation of Stephen Moran's version, is a full-blown implementation of this tactic into a full-blown strategy. All right, so we've got tons and tons and tons of gold, allegedly, right? We hedge it by selling it forward. We don't sell it, but we hedge it. And then we take the funds and we go out and we buy. Who are we negotiating with? Who do we want to buy our goods? Japan. We want Japan to buy our cars? Well, we need to make the dollar weaker, right? So we will then take our dollars and buy yen with it. It makes the dollar weaker versus the yen. It makes them more likely to sell us to sell more cars to them because our dollar is cheaper. And it closes it's kind of like a Plaza 2 Accord, one deal one bilateral deal at a time. And I think this is something. So that's the whole mechanism of it. I mean, I didn't want to go down a rabbit hole too much, but I think there's a lot of misinformation. Such a common word, such a nonsense word, but there's a lot of error out there in understanding this. Everyone's in love with Stephen Moran with his Mar-a-Lago Accord, right? That's what they were talking about a couple months ago. And although it was officially put on the side, he actually said this in a public statement. They're starting to do it. They're starting to do things in it, and I'm seeing that. And the bilateral deals that he's negotiating. Now, what the Moran idea is, what I said, only literally selling the gold. And he even says it's politically unexpedient. It's politically a third rail, something like that, he says. And so he wants to take the gold and sell it and take the proceeds and buy other people's currency, retiring our debt in doing that. We're buying someone else's debt. I don't think that'll happen, but I do think down the road you're going to start seeing us start to hedge our debt. But in doing all this, we lower the debt, we weaken the dollar for trade, and would be supportive of allies who want their currency stronger to begin with. So here's the real reason I believe it will have to happen. Not tomorrow, probably not this year, but it'll happen. Number one, just zooming all the way out to the political environment. We need to monetize our assets. If you own land, you need to sell it. If you own gold, you need to get money for it. You need to monetize our assets. And there's a lot of assets we can monetize. Freddie Mac's going to go public again. Fannie Mae's going to go public again. These are assets being monetized, right? One way or another. We're either going to sell it, loan it, or go public with it, something like that. So that's the first thing. And the culture, and Scott Bessent had said that. He said, we're going to monetize assets. And then that's when everyone started saying, oh, they're going to revalue gold, right? And then the Bitcoin people were saying, revalue gold, take the proceeds and buy Bitcoin. No. Revalue gold, take the proceeds and buy debt, retire debt. You can buy Bitcoin too if you want. But anyway, you could see how once you start fighting over what we buy, it becomes a disaster and it becomes a partisan problem. All right, so that's the first level, right? We're going to monetize assets. And gold is one of the most obvious assets. Now, Tom Luongo, who we're friends and we're mutuals, he had focused on the housing, uh, Freddie Mac, Fannie Mae, and he's correct about that. There's other things that we could do too. Uh, you could offer people home equity loans, HELOCs, right, tied to treasuries, and in doing that, you tell them we'll give you a loan against your treasury, against your home equity if you put it in stock. So we're just kind of extending and pretending a Ponzi, but those are things we could do. But I'm sorry, I digress. The real reason what I'm describing will have to happen, whether it's Stephen's way, whether it's my way, whether it's Grant's way, or whether it's anyone else's way, is as government, now we got to go out to the fiscal problem. Every country has to spend more money, right? As government ratchets up necessary spending on social safety nets. In Europe, got all these immigrants coming in, right? Rearming militaries. In Europe, they have to defend themselves now that we're withdrawing from NATO, and we have to modernize our military as well. And rebuilding supply chains and factories. All that's money that's being spent. That's spending money. That's inflationary, and it may be for a good cause, but it's inflationary. And the fiat, the debt will balloon, the fiat will devalue. Fiscally and monetarily, this will be very, very bad. The Fed won't be able to raise rates. This is like a current event now. The Fed, in raising rates to slow down money, will actually increase our debt burden because we'll have a higher interest rate to pay. So it really kind of puts the Fed in a bad spot. Now, tapping the piggyback will keep balance sheets whole. That's good. Tapping the piggy bank will allow us to unlock value without spending it. Now, spending it by retiring debt is what I mean. And allow central banks to fight inflation if they choose to do so without jeopardizing their nation's well-being. So at some point, now I'm going to bring this to something the Bank of America said 4 months ago and said again. Michael Hartnett, their CIO or CTO, CIO said this weekend. So it's just current events. At some point, as central banks are buying gold, that's what they're doing. They're buying gold, right, to de-dollarize. Why are they buying gold? Well, they're buying gold because they need something to diversify their financial risk. They need something to go in and buy stuff in China. If you need gold, right? You need to get out of the dollar risk. Well, in doing that, they're going to be seeing the gold go up, which is what we're seeing, and the other fiat that they have go down. So I'm a central bank in let's say Europe. I've got euros, I've got yen, I've got dollars, I've got gold. I now have 20% of my gold. Now, Bank of America said about 4 months ago, and Goldman said something very similar. They said that central bank buying will not stop until they go to 30% of their portfolio. Right now, they're 20. So they have to increase their buying by another 50%. And the reason for that is when you look at the diversification, kind of like when you're diversifying your stock portfolio, when you look at diversification of currencies, you need to have ideally roughly 30% of your money needs to be in gold to balance the losses that you're going to have from the fiat. So we need to do that as a central bank to offset our losses. So as the fiat's going down, the gold's going up. But no one's marking the gold to market on their books. It's being marked at whatever, $42, $5, whatever. So at some point, the most logical choice will be when they have their 30%, not before, when they have their 30%, you raise the price of gold. And this has happened already. They've done, and going back to the paper that you brought up in the beginning, which I read, and I'll come back to their opinion on why they said what they said. But when during the creation of the euro, they revalued gold to ease the stress on balance sheets at the central bank. I believe they're going to do that again. Now, we need debt relief, or more specifically, as currencies drop and bonds drop, the Feds, the central banks will just lose money, right? I mean, how many NERP, negative interest rate bonds do the governments of Europe have, like, on their balance sheet? Those are worthless. Like they're so unless some alien lands, right, and wants to buy our treasuries and Euro bonds and Japanese government bonds, unless someone lands like on Earth and says, "I'll be a new buyer." Well, if he doesn't, either we do this or we go full austerity. You have to tap the biggie bank, and that's what's going on. Now, I wanted to just touch on what Michael Hartnett said. I don't have his quote in front of me, but I did two pieces on that this weekend. And he has a report called The Flow Show, and it's very popular. Zero Hedge alerted everyone to his work, and I started to pay attention when he started talking about commodities. He's an equity guy for the most part, and he goes through this list of why gold will withstand peace, straight up, right? And his peace is bearish for gold. And here's why that doesn't matter in the long run. One, governments need to keep spending. Two, governments need to deal with immigration. Three, some of that is a little bit bizarre, but three, governments are more isolated now, which goes to my point about supply chains and military spending. He goes through all these things, and the last thing he says, almost like a throwaway statement. I mean, really, he says, central banks have 20% of 20% of their reserves are in gold, and 30% is where they're headed. That's from another report. And he goes, not I think. I mean, it's obviously his opinion, but he says central banks have 20% of their reserves in gold. At some point, they will have to revalue to offset the losses and everything else. And he's right. So we're going to have it happen. What's the price? I don't know. What are they going to spend it on? I don't know. They could end up going out and buying fart coin. Like, I don't trust the government, but unfortunately we have to live with them. So that's my revaluation. It's going to happen. I believe, right? I believe that they'll do it reasonably, responsibly, but not very responsibly. So let's hope they do it right. That's it.
Great summary. I want to shift over to the silver market for a moment here. This is a market that online, my show's guilty of this as well. I have a lot of guests that come on and call for triple digit silver. Silver's about to go to the moon. $50 silver is kind of the number that gets thrown out a lot. And when silver moves, it moves fast. Gold leads a precious metals bull market, then silver catches up like a slingshot. All of the statements that are made about the silver market. So I'd love to get you to separate the signal from the noise for us, because we have seen silver reach 14-year highs, getting very close to $40. Of course, inflation adjusted for even the 2011 spike, we would be in the triple digits at this point. I wonder what your thoughts are on the silver market at present. Is it realistic to expect triple digit silver, and especially at the speed at which a lot of people are saying it's going to happen? Don't blink. You'll miss it. What are your thoughts?
All right, let me just answer that directly before I go into the good news. No, triple digit silver can happen, but it'll happen in the blink of an eye. And the government, the first time up, it'll happen in the blink of an eye if it happens, and it won't be there long. So I don't think that's something that you should be expecting. And I'm not trying to throw water on it. Silver is I'll get into this now. All right. So silver is my first commodity long. It's the first commodity that I traded options on. So I'm very fixated on it as a floor person. Now, historically, the axiom that gold leads and silver follows, yes. And then it outperforms, yes, but not now. I'm not saying it won't happen, but in the past, that was investment flows. Why was that true? Well, because when people wanted to hedge inflation, they bought gold, or they wanted to hedge, they bought gold. And then when it got to a certain point, they said, oh, silver's cheap compared to gold, and they bought silver. And so silver would, like the rubber band, overperform. That's in the smaller cycles. In the bigger cycle, going back to 2009, and since COVID, you've just seen gold rally and silver do nothing until the most recent months. And that's because silver is not money. Now, before they write the hate mail into you, Silver is not money. It's more than money. And I'm being sincere here. Gold is money. And it's money because, ironically, it's useless for anything else. I know there's a little bit of electronics out there. We don't care about that. Gold is there. It's not destroyed. Now, silver's not destroyed either. And it's hard to get back, but it's industrially important to use. So the ascent of gold, the extended ascent of gold, because of central bank buying, will continue to outperform silver for a little bit of time. What's going to happen is that whole gold and then silver slingshot thing, that's going to happen, but not in a short-term way. It's going to happen in a bigger picture way. Now, I'm not saying it. What I'm saying is before I even get into who's buying it right now, Russia's central bank has announced that they're going to be acquiring it, not necessarily for a monetary reserve, but as a store of value. They're calling it a critical mineral. It's a critical mineral. It's a critical metal. They just can't call it that because to do that makes it go up in price. It's really that important, and it's important going forward. So you got central banks, especially in the East, are buying silver. Sovereign wealth funds, central banks. India buying more than they need. China buying more than they need. I don't care how many solar panels they make. They're still buying more than they need. Russia buying it, I'm sure. I'm not sure how, but they're buying it. All these things are happening. That's the first thing. The second thing is when gold stabilizes at a higher price, and this is a BRICS comment, the BRICS are using gold as money to pay for commodity deals. And they'll use it for other things too. But so what they're doing is all the correlations that we grew up on, Neo-Keynesian correlations, gold versus the dollar, those are the correlations that have mattered for the last 50 years. Gold's priced in dollars. And that's true. But now, using China as the point of the spear, gold's correlated to nature. So gold to oil is going to matter more again. Gold to other metals is going to matter again. Look at what happened to platinum. Look at what happened to palladium. Always does that. But look at what happened to platinum. Look at what happened to silver. I believe you're looking at, I use the Game of Thrones analogy. I don't know if everyone's familiar with it, but the Ice King, whatever his name is, the guy who raises everyone in that scene by the water, right, raises from dead. Well, it's like gold is going like this. Okay, time for everyone to reassert themselves in their natural form. And that means silver goes to 42, then 51, then $60. To me, that's what's going to happen. Now, that's my big picture and my explanation of why silver will catch up and outperform. Now I'll get into a little bit of the minutia of why it will happen, and then we'll talk about who's buying it right now. Gold and silver are treated the same way by central banks, by bullion banks, by dealers who deal in them. But as I said, gold is useless except as money. So everyone in the world has it, and at a price you can get it loaned to you to satisfy a debt. So I am short a gold contract. I need to make delivery. I'll borrow it from this central bank, and then I'll pay them back when the production comes online a month from now. That's how it works. Gold is money. It's only replaceable with gold, and it's not used for anything else. And there's a ton of it, multiple tons of it, lying around. At the right price, it comes out of the woodwork. Silver, no, not so much. These central banks all sold their silver over the last 50 years, and for good reason. You're talking about space. There is no silver lying around. We're in a production deficit. The mining industry has been decimated as a pure producer of silver. And of course, it's been decimated because silver is a byproduct of heap leaching of other metals, yada, yada, yada. But that's a crowded trade. Everyone's done that. Everyone's been pulling silver out of iron, out of nickel for decades. And it's not happening anymore. And here's why it's not happening. Just to stay with what I'm focusing on here is gold is available for borrowing. Silver is not. Okay? You can't kick the can down the road with silver as easily. Example, China. China wants or needs to buy more silver than we know. Are they doing it on the exchanges? No. No. They have the manufacturing. They have the refining capacity. And I'm not even, this isn't even my opinion. This comes from First Majestic. It comes from a couple other miners that China is going into Latin American countries and undermining and taking over the supply chain for raw silver before it gets to the exchange. What are they doing? They're going into a Latin American country and they're saying, we'll take something called your concentrate. And what your concentrate is basically your bags of rocks that have a high concentrate of silver in it. And we'll take it. Now, everyone does that to an extent, but China has ramped it up. Instead of saying, we'll buy your concentrate for whatever it is, $1 a pound. I'm making it up, right? Well, $1 a pound, we'll pay $1.50. And you don't have to clean it up for us. We'll do it. So the foundation of refined silver has been co-opted by China. And I think, to echo something that Josh Fair had mentioned to me at Scottsdale, I think that we have finally realized it. And that's why the copper tariff, whether it's used or not, that's why what happened recently where the U.S. is now securing its minerals. You know, the copper scrap. You know, China's been picking our pocket on copper scrap for a decade. They come in, they buy it, and they take it out, and they ship it out. So we're doing that, which now bringing us back to silver. There's no extra silver laying around. There's no coins in the cushion that you can go on your couch and get. And so the mindset of the banks has always been, we can always borrow it. And over time, they can't borrow it anymore as easily. And over time, they've become dependent on retail selling. And retail has a lot to sell, and they do sell. And scrap, which is hard to find. Scrap doesn't come out consistently. It comes out in lumps at a price. So what they're doing is, I mean, I don't know exactly what they're doing, but there's like a Peter to pay Paul type of thing here. And so the banks have, let's say they have, 200 million ounces in a vault. And of those 200 million, 150 million are spoken for the ETFs. Well, they only have 50 million to use. And they have to get it elsewhere. And essentially, if you listen to people like Daniel Gali at TD Bank, TD Securities, his estimate is they really have nothing left over, nothing laying around. It's because it's all spoken for. And I think you could have that 100 spike to triple digits. You better have your order in if you think you're going to sell it there. It's not going to happen and stay there the first time. So I believe that silver is, without pumping it up too much, silver is going to go up. Now, if I could just give you the recent months, just to really bring it down to the narrow.
Yeah.
There's a segment of investment firms I call them macro discretionary funds. And what they are is they're the biggest hedge funds in the world. And they could be sovereign wealth funds. They could just be really deep-pocketed funds. And they have a longer time frame and a more settled will when they put a trade on. They're not momentum traders, they're not mom and pops, and they're not even regular hedge funds. And they're global. Now, the last time, they've never been in metals for years. They haven't been in metals. And then in December of 23, I saw behaviorally some behavior that said to me macro discretionary was involved. And I watched. And as we go through 24, the market, if you're looking at a chart from December of 23 when it makes a high to about February 28th of 24, gold goes sideways to down a little bit. And then in March 1st, it explodes. And it exploded because it was on everyone's radar. There was a quarterly close or a monthly close that mattered to them. So simplifying it, macro discretionary has everything in the world on their board, right? And gold's on their board. And they say, tell me when gold closes at new all-time highs, or tell me when gold. And that's what happened. So at the end of the year in 2023 to 24, that happened. But they were patient for some reason. And then in March, it started to rally again of 24. And I think the Chinese macro discretionary funds had a lot to do with that as well. But the reason I'm bringing that on is because they started buying roughly in March of 24, and they didn't stop until April of 25. Right? So, I mean, I'm sure as a class, some were selling as it was rallying. Most were selling as it was rallying. But they hurt the bullion banks. They made the central banks pay up more. And, they're not someone to be ignored. That's what just happened in silver. Okay? So here's me getting you excited again. Silver, as you alluded to, did you say it was a 14-year high?
Yeah.
Yeah. Okay. So macro discretionary funds and the bigger investors, they have that list. Call me when silver makes a new monthly high. The guy goes, I don't care. I'll trade something else. It's just silver. Call me when it makes a new quarterly high. Okay. It did. I don't care. Call me when it makes a new mid-year high. And we made the highest mid-year high of all time. That's significant. You can't ignore that. And sure enough, from July 1st on, it ripped. These people are not getting in it to sell it a month from now. So look for them to be in anywhere from 6 months to 18 months. And that will be the catalyst to propel us meaning silver, to a higher level where it stabilizes. So I think if you, I don't like to put targets on things, but if gold were trading 3,500, you could theoretically is not the right word. You should see silver trading above 42, obviously, right? And as high as 50. So I think ultimately, say 2 years from now, the gold silver ratio could stabilize at around 50-1, which would mean $60 with gold trading 3,500. Probably won't happen at first, but you follow. Like as silver catches fire, there's nowhere to hide now. Platinum's up, palladium's up. A lot of these funds, not the macro discretionary guys, but a lot of these proprietary carry traders, guys who were short the yen to buy stocks, when they bought gold, they sold silver. They did that because gold's money and silver's half money. So let's sell silver, let's buy gold, and if we think the economy is going to do better, we'll just buy copper. And so they have these massive positions. And what we've seen since 2 months ago is a semi-disorderly removal of that position, selling the gold, buying the silver. Did gold drop? No. Silver went up. So that'll tell you that the pressure point is on for silver to go higher. That's what I think. That's it.
So one question I want to ask is how you would characterize China's role currently in the gold and silver markets, because in regards to the BRICS framework, it looks like those China and Russia and those other nations, as you alluded to earlier as well, are looking to de-dollarize and use gold more for settlement of international trade. How does that whole picture look to you right now? What is China's role and the role of the BRICS nations?
Gold's a pet rock, as I've been saying. It doesn't do anything. Well, they're going to make the pet rock do something. So to answer you in short order, China's influence is growing. They own the supply chain, as I mentioned with that concentrate comment. They are now coming after the payment chain. Now, payment chain means pricing. So they wrecked the LBMA franchise by pulling metal out of there. They caused a premium, and they're causing the pricing power to, it's like a trading places thing, turn those machines on. The machines are on over there, and the machines are pulling so much demand for the precious metal that the bullion banks in America are now operating over there. So they own the supply chain. They pull it out of the ground, refine it. Let's use silver. Make it a paste, put it on a solar panel, sell the solar panel, install it. That's a supply chain. Okay. What's the pricing chain? Well, at every point, money changes hands, right? So now that it's being priced in China, and you're gonna see it priced on CNBC in Chinese yuan at some point, and that's critical as a pillar to supporting the dollar as a global reserve currency. because if gold goes up in new all-time highs in the Aussie dollar, who cares? Gold makes new all-time highs in the dollar, we care. And then it's the renminbi, et cetera, et cetera. So the BRICS, they will seek to use commodities for commodities, which I alluded to, right? They will use gold. This is what they're going to do first. They will use gold to settle monthly differentials in trade between nations. I buy your wheat, you buy my oil, we settle the difference in gold. That's happening, right? Next, and this is what they're doing right now. I did several big pieces on this. China is going to encourage members who need to build infrastructure. So think Africa. Now, I'm not saying I trust them, but this is how they're going to do it. They're going to say, okay, Africa, you want to build infrastructure, you want to build a highway, you want to build an airport. What do you have? We got gold. Well, in the past, what would the U.S. do? They make you sell the gold, right? And they make you sell the gold cheap. Now China's saying, well, you can put it in a bank, in a vault, and we'll exchange it for yuan, and we'll use it as collateral without selling it to spend on infrastructure. So gold will only increase in importance. And that is why, when you think about it, we repatriated some of our own gold recently. Without gold, no one will hold the yuan like they hold the US dollar. And so China needs that. Gold cements the trust. So I would say that if you want to look at the end game for China, gold makes the yuan stable. That makes the BRICS trust them. And the yuan makes the gold more flexible. So it's convertibility. And in the long run, what they seek to do is they want to internationalize the yuan, and they're going to piggyback it on gold. And that's it. I mean, it's not going away. We need to have gold.
Well, Vince, this has been such a fantastic conversation. So many great insights shared. Could you tell us about GoldFix, where people can find that, and anywhere else you'd like to direct people online, feel free.
I have a newsletter, right? And that's, first of all, I'm career-wise, in case someone's looking for pedigree here, I'm a commodity trader, derivatives trader with over 30 years of profitable experience. I'm also an adjunct professor at UConn. During COVID, I started something called GoldFix, and the letters are VBL, Victor Boy Larry, goldfix.substack.com. And that is a newsletter that started just about gold. But since then, it has become gold, silver, geopolitics, commodities in general, kind of like what your list of things to talk about is. And we're in the top 50 of Substack financial newsletters now. And there's only one other gold person there. So we're pretty happy about that accomplishment. And we send out 2 or 3 posts a day, and there's no spam, and we're not selling you anything except knowledge. So happy to have you.
Great. I'll put that link in the description below. Thank you once again, Vince, for coming on and sharing your knowledge with the audience.
Thanks for having me, Jesse. I appreciated it.
Thank you for joining us today. ARC Silver Gold Osmium. Take advantage of their special right now. Silver Kangaroos 2023 1-ounce coins, $2.47 over spot. Silver Maple Leafs 2025 1-ounce coins, only $2.87 over spot. Well supplies last. Reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys on the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.